Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 15th of January 2020. And yesterday we produced a video entitled, Is China No Longer a Currency Manipulator? And the day before, gold and silver prices fall as US-China trade deal signing is imminent. Now we've placed links to both of these in the description box below. Now at the time of producing this video podcast, which is 11:30 GMT, we've not had the opportunity to hearing confirmation that the US-China trade deal has been or has not been signed, and so we shall cover this in tomorrow's podcast. Meanwhile, what we can cover is slightly conflicting information coming out of Germany and the United Kingdom about their respective economies. But before we take a look at these, it's worth briefly mentioning that at the time of writing, and no doubt this may indeed change in a few hours' time, depending on the trade deal signing, gold is standing at $1,553 and silver at $17.86, with the Dow having closed yesterday up 32 points and the FTSE 100 index up just 5 points this morning. The dollar index has fallen slightly to 97.29, thus the small rise in gold and silver prices, and crude oil prices are down around 0.14%. So let's first take a look at the United Kingdom and then Germany in articles published by Bloomberg earlier today. Bloomberg article: UK inflation slowdown ramps up view, a Bank of England rate cut is imminent, by Lucy Meakin and David Goodman, January 15th at 10:30 a.m. GMT, updated January 15th, 10:27 a.m. GMT. The path to a Bank of England interest rate cut as soon as this month became clearer on Wednesday after inflation unexpectedly slowed to a 3-year low. The pound fell and traders increased bets that policymakers would reduce rates on January 30th, as the shock reading reinforced speculation, fueled by dovish comments from Bank of England Governor Mark Carney and others in recent days. Less than an hour earlier, Bank of England policymaker Michael Saunders, who's been voting for lower rates, said the UK economy needs an injection of stimulus to avoid a prolonged period of below target inflation. Markets are boosting bets on a rate cut as soon as this month. UK consumer prices rose 1.3% from a year earlier, the least since November 2016, while the core rate also declined. Headline inflation has been below the Bank of England's 2% target since August, and economies expected to continue to undershoot until at least the middle of next year, thanks in part to the appreciation of sterling in 2019. Expectations of a rate cut have rippled through markets, pushing the pound down almost 2% since the start of the year. The currency fell further on Wednesday, dropping 0.2% to $1.2995, basically $1.30. Traders are now pricing in a more than 60% chance of a cut in January, up from 44% on Tuesday. A move by May is now almost fully priced in. A key date in the debate over the rate cut timing is January the 24th, when Purchasing Managers' Indices will provide an overview of the economy at the start of 2020. In a speech on Wednesday, Saunders said that a sluggish economy and evidence of a weakening labour market will likely lead to a longer period of subdued growth. That would create a disinflationary and persistent output gap, and the risk warrants a, quote, relatively prompt and aggressive response, unquote. Saunders is one of two dissenting voters on the Bank of England's 9-member Monetary Policy Committee. He's been calling for an immediate 25 basis point rate cut since November, citing downside risks from a weaker global outlook and from more persistent Brexit uncertainties affecting corporate and household spending. Quote, if we defer easing near term, and in the event of persistent economic weakness face the need for greater easing later on, then risks of a low inflation trap, which would certainly not be a benign outcome, would rise, unquote, Saunders said. In response to questions after the speech, Saunders said that UK data currently justify a rate cut, and the Bank of England has the tools to boost growth. That view appears to have been gaining traction with his colleagues. In his first major speech of 2020, outgoing Governor Carney said the MPC, which is the Monetary Policy Committee, has plenty of firepower to aid the economy if necessary. Policymaker Silvana Tenreiro followed by saying she may support a rate cut in the next few months if sluggish global growth and Brexit uncertainty persist. Another member, Gert-Jan Vlieger, said he'd need to see an improvement to justify waiting to cut. Saunders warned that Brexit risks will persist in 2020 as the United Kingdom negotiates its future relationship with the European Union. He also dismissed the possibility that moving too quickly to cut rates raised the possibility of a policy mistake. Quote, "Of course, it is possible that we cut rates now and then find that the economy rebounds and renewed tightening is appropriate, say a year from now," unquote, Saunders said. "I don't think such a quick reversal is likely, but it is not inconceivable. I would not regard such a reversal, if it occurs, as a policy failure. It would be a benign outcome. Monetary policy would have helped underpin the pickup." End of article. Germany reports its slowest economic growth in 6 years. Bloomberg article by Caroline Look, Chris Reiter and Ian Rogers. January 15th, 2020, 9:03 a.m. GMT, updated 10:05 a.m. GMT. Germany's economy made a slight recovery in the fourth quarter, ending a year in which manufacturing took a battering and the country was dragged to the brink of a recession. The Statistics Office estimates that output registered a small increase in the final 3 months of 2019, a year that saw growth of just 0.6%. That's the slowest in 6 years, amid trade tensions and a broader slowdown in demand that added to fundamental structural challenges the country is battling. The small increase in GDP at the tail end of 2019 may reinforce hopes that the economy is through the worst of the slump. It also means less chance the government will cave to calls that it provide more fiscal support for the economy. But the economy, and particularly its industrial heart, are far from out of the woods or trouble. Car makers, include Volkswagen AG, are facing a critical period as they push sales of electric vehicles, while manufacturers such as Siemens AG are under pressure to adapt to climate change. Geopolitical uncertainty in the Middle East and continued risk of a disruptive Brexit will also weigh on sentiment and momentum. The figures for 2019 showed investment and exports posted only modest gains. At the same time, private and government consumption, as well as construction, accelerated. The government recorded a budget surplus of 1.5% of GDP. And as you can see in this chart, private consumption is up from 2018. Government consumption is considerably higher. Equipment investment is more than considerably lower. Construction is up 50%. Exports are down more than 50%. And imports are down almost 50%. Quote, "After a dynamic start to the year and a decline in the second quarter, there were signs of a slight recovery in the second half," unquote, said Albert Brackmann, head of the Statistics Office department that compiles GDP. The euro was little changed against the dollar following the remarks. German 10-year bonds slipped for a second day, declining 3 basis points to minus 0.20%. They've been slowly edging back up towards positive territory, recently on hopes that the economy is through the worst of the slump. Business expectations improved at the end of last year, and the Economy Ministry has pointed to a slightly better outlook for industrial activity. Yet actual data are still largely disappointing. Manufacturing orders continued to decline late last year, and exports dropped. In the 19-nation euro area, industrial production rose 0.2% in November, less than economists predicted, as output of intermediate and consumer goods declined. Germany's outlook for 2020 is barely better than its performance last year. Economists see growth accelerating to only 0.7% this year. The US, by comparison, is forecast to expand more than twice that pace. Persistent weakness has fed calls for the government to ramp up fiscal stimulus. It's already pledged to step up investment in infrastructure and education and committed to spend 54 billion euros, or $60 billion, fighting climate change. Controversially, Greg will be happy about that. More than Germany's stimulus plan following the financial crisis. It said more support will be available if the economy deteriorates. 2 weeks into the new year, Germany is among the first of the world's advanced economies to publish 2019 GDP figures. As the world's third largest exporter, it acts as a bellwether for the global economy, which is widely estimated to have had its worst year since the Great Recession a decade ago. End of article. What is interesting about the UK lowering rates is that the Governor of the Bank of England, around 12 months ago, and earlier, stated that if we come out of the European Union, we should expect rates to rise in order to protect the pound. Now it appears the opposite is going to happen, as inflation is benign and potentially falling. Now, the figures we've managed to accumulate so far in-house, and we have to accept that there is more economic data to be released before the 31st of January, an interest rate cut, in our view, is not warranted as yet. If one is taken, it's more of a preventative measure rather than a necessity. We are of the view that a rate cut in March would be a more realistic contender at this stage. But we're working with data that is a month or so out of date. Moving on to Germany, it is indeed more important to bear in mind that with the United Kingdom out of the European Union, much of the financial burden that our removal causes will primarily fall on the back of Germany. Now, we can already see from the article that Germany's economy is most fragile and is a hairbreadth away from moving into official recession. It's good news that it hasn't already gone there. But from the chart, we can see that government spending or investment has prevented this from happening, especially as the export figures are indeed quite weak. Now, we could of course be wrong here, but where we and controversially Greg are at one, and that is we believe that the UK economy may indeed suffer short term from its Brexit decision, but it will empower our government to strike deals it was prevented from doing when shackled within the European Union, and longer term will prove most beneficial for the country, providing, of course, our leaders make sensible deals and decisions. We're also of the view that the UK's removal, and especially if the UK prospers, will act as a forward guard, if you like, for others within the EU to follow, and could eventually lead to its reduction in size, if not its ultimate collapse. But we accept that could be many years into the future. What is critical, though, for global trade is the behaviour and decisions taken by the United States. We have often quoted, "When America sneezes, the world catches a cold." And this is paraphrased for good reason. There is no doubt in our minds that many Western economies are reliant on the United States and how it interacts with its trading partners. It is, after all, the largest economy in the world. China and India too are also important economies, plus currently the EU trading bloc. Now, we fully support President Trump's efforts to call China into account, and whilst we would have adopted perhaps a different tariff methodology, more along the Scaramucci recommendations, Nevertheless, hopefully a deal will be signed today, and an even better arrangement finally negotiated as Phase 2, and again signed in the first 6 months of 2020. What is comforting, at least, is that confidence may now increase amongst businesses, and we may see, both in the US and the UK, and perhaps Europe too, greater corporate investment moving our respective economies further forward for the benefit of all our people. Only time will tell if this happens, but if it does, those predicting imminent economic collapse will yet again be sorely disappointed. What do you think? Do share your views. And thank you for listening, and please subscribe to our channel and press the bell sign so that you may be notified of future videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.